It's chaos in crypto land. In just 6 weeks, over $1 trillion of cryptocurrency market value has evaporated Bitcoin. The king of crypto has plunged about 27% from its October highs to around $91,000, its lowest since spring altcoins are bleeding too. Ethereum recently dipped toward $2,900, a roughly 6% one-day drop, and is now nearly 40% below its August peak. The mood is grim. If you're holding crypto, this is a shock. But what happened? It all began in October 2025, after Bitcoin peaked around $126,000. By mid-November, it had fallen below 90K highs for the first time in 7 months. CoinGecko data show the total crypto cap has slid by about a quarter since early October. Investors are asking, is this the start of a crypto winter or just a nasty correction? Unraveling the crash, tech sell-off, Fed tightening, ETF exodus. Several factors combined to spark the sell-off. First, Wall Street panic over tech and AI drove a broad risk-off mood. In one day, NOV 20, U.S. markets shed $2.7 trillion as mixed jobs data and overheated AI valuations caused a tech sell-off. The Nasdaq plunged 2.2%, even after NVIDIA's blowout earnings. Cryptos didn't escape. Bitcoin briefly dipped 4.2% to about $86,300 on that day, mirroring the jump in the VIX Fear Index. In short, when tech stocks wobbled amid AI bubble fears, crypto followed suit. On top of that, monetary policy and liquidity tightened. Fed minutes and a mixed jobs report left markets betting no early rate cuts. As economist Kevin Kelly, Amplify ETFs, notes, delayed Fed cuts and a huge U.S. Treasury cash surplus drained liquidity, making risk assets like crypto highly sensitive. In plain English, money is tight. Higher rates and reduced Fed stimulus have investors wary of high-risk bets, whales, ETFs, and crypto hangover. Meanwhile, big crypto holders and funds started selling. U.S. Bitcoin ETFs saw massive outflows, roughly $3.7 billion pulled since early October. The flagship iShares Bitcoin Trust, BlackRock, suffered a record $523 million withdrawal in one day. In other words, whales and institutions that piled in on the ETF boom are now moving to the exits. CryptoQuant reports that the recent sell-off is largely holders taking profits, not forced margin liquidations. Large whale wallets have been dumping coins, pushing prices through support levels. Kraken's chief economist even describes it as a crypto hangover. From August, AES borrowed money rally. Profit-taking by crypto treasuries has added fuel. Many Bitcoin treasury companies bought nearly $50 billion of BTC over the past year, now that rally has stalled. Analysts note these firms, e.g., MicroStrategy's strategy, often trade below net asset value, signaling caution. Standard Chartered warns that if Bitcoin stays below 90K, half of those corporate hoards could be underwater, worth less than they paid. In short, the big stackers who once said buy and hold are hedging and selling too. Ethereum, altcoins, and institutional players. It's not just Bitcoin. Ethereum and other large tokens are sliding with the wave. As noted above, Ether fell faster, around 6% on one trading day, and is down 40% from its summer peak. Broad crypto fear is now at extreme levels. Many altcoins have plunged even more sharply in this risk-off environment. Institutional flows reflect this. Crypto funds and ETFs linked to Bitcoin and Ether have seen capital outflows amid fading demand. Even crypto stocks and miners aren't immune. Companies like Coinbase and Marathon Mind have swung with Bitcoin prices. Social proof and sentiment have turned negative. The crypto fear and greed index is now in the extreme fear zone. Every bit of bad news, from tech stumbles to Fed talk, triggers more selling. Government and regulation, pro-crypto laws versus market reality. On the regulation front, the story is strange. The new U.S. administration has actually embraced crypto, signing pro-crypto legislation and orders. In July 2025, President Trump signed the Genius Act, creating strict rules for stablecoins and even establishing a strategic Bitcoin reserve and digital asset stockpile for the U.S. White House.gov. And after a lengthy shutdown, the SEC just resumed reviewing crypto ETF applications. Many filings were pending. Yet markets have largely ignored these headlines. Traders care more about interest rates and risk sentiment than glossy policy. Even with talk of American crypto leadership, none of that stopped the slide. If anything, the sell-off suggests investors are unconvinced that policy alone can prop up prices, especially when macro worries loom. What's next? Engagement and look ahead. So, what now? Analysts are divided. Some see this as a brutal but normal correction in a volatile asset class. Others warn of deeper losses if 8490K support fails. One report said 74K could be next. The continuing ETF outflows and tech stock skittishness suggest it could linger for months. But one thing's clear, it's a dangerous moment. Are we in a full-blown crypto winter, or just a temporary storm? That's the big question, and we want to hear from you. What do you think? Drop a comment below. Are you buying the dip, hodling, or bailing out? U.S. investors especially. How do Fed and policy moves figure into your strategy? Stay with us. In our next video, we'll dive into strategies for surviving this crash and share what might come in 2026's crypto market. Subscribe and ring the bell so you don't miss it. Until then, keep your eyes on the charts and your wits about you. Crypto may be volatile, but so are opportunity, especially after a crash. What's your take on today's meltdown? Let us know below, and we'll continue tracking this story closely.